we can start, right?
Yeah.
So, hello everyone who has joined us. Great to see you all here. Steady State welcomes you and thanks you for joining us today. So, my name is Sylvia, aka Crypto Empress. I am the CMO of Estonian Cryptocurrency Association. And I'm here today to help you get your questions answered and to delegate the fireside chat. So our today's speakers are Jonathan Libby, who is the founder and CEO of Steady State, Akash Mahendra, who is the head of strategy and operations of Steady State, and Brian McCabe, who is the CMO of Steady State. Any questions that you have during the presentation, you can write them to the stream chat and they will be answered in the end, and we will forward them to our hosts. We also had a best question competition for $50 in stablecoin giveaway. The winners are at Callis, at DAO, and at Zoom Crypto Community. We will ask the questions they ask in the end. And also, there is the second giveaway for $100 stablecoins that was posted in our Twitter, LinkedIn, Facebook, and Instagram, as well as our community chat on Telegram. Make sure you follow the rules and post your screen name in the chat here. We will also announce the winner at the end. So let's start. Let's talk about DeFi overall. So DeFi has grown into a strong, self-sufficient, and worldwide financial ecosystem that offers alternatives to key financial services, such as investing, borrowing, and trading. Total value locked has passed over $150 billion. But unfortunately, this acceleration has come at a cost for many participants. Over $500 million was lost in smart contract exploits alone. So, Jonathan, can you please maybe share some more insight on the problems with DeFi insurance?
So I think DeFi insurance is an interesting sphere because it's really not developed well yet. You know, you think about the largest protocol, which is, in my opinion, doing great work, Nexus Mutual. They only have $900 million of AUM, in policy payouts. So I think I think if you think about the space of insurance as a whole, there's about 100 to 150 billion dollars assets under management, and basically a billion or less of assets insured, or maybe 2 billion range. I think what we see there is there's a huge disparity for protection versus overall market size. And when you really look into the details for why that's the case, I think one thing you really start realizing is it's because we don't understand the risks ourselves often. Like I myself, I am finding about new risks every day in this space when I invest or get involved. And there's an irony where the only insurance available currently is for retail insurance, and for retailers to get coverage for their downside risk. And I think the industry is starting to realize, with as long as we have, is there's a need for protocols who understand their risk better, the professionals in DAOs, the professionals in the DAO organizations, to get some kind of layer of protection for the community as a whole. And so I think the state of insurance as a whole there's a massive disparity between potential and where we're at right now because of our focus on retailers. And I think if we actually maybe change the focus, we're allowing opportunities for DAOs and communities as a whole, as a protocol, to get protection for their communities. We could really then actually start seeing some serious growth in the space of DeFi. But that's my opinion of the space of DeFi insurance currently, and the big disparity and what we need to be done, I think, to bring us to the next level.
Just following on from what John said, now there's obviously an existing problem in the DeFi industry. There is, a promising and fast-growing market for DeFi insurance, and as John mentioned before, there are protocols such as Nexus Mutual, ETHRisk, and Unslashed who are striving to solve some of the toughest challenges faced by platforms and users in general. And I think it's Steady State's view that until these challenges are met and solved, it'll actually hinder DeFi's growth for a long time. So, we can discuss this a bit later on as well, like what Steady State offers and what the model we are going for. But there's a lot of challenges in the market, such as, subjective claims processing, inconsistent risk analysis, inadequate coverage, low liquidity, and, a lack of proper capital efficiency. And until these issues are solved, it's going to really hinder the growth of DeFi to the mainstream, the mainstream users as well as institutional investors.
Yeah, just really quickly following on from John said, like the way things are working in the space right now, it doesn't make any incentive to basically grow. Like as he said, everything is retail insurance, so you're more or less responsible for ensuring your risk, even though it might not necessarily be your risk. It might be a protocol's risk. It might be security or like an investment pool risk. And I guess you could say when you see like with the emergence of what we're talking about now, which is like central bank digital currencies, like we have a digital euro and a digital yuan coming out. I mean, imagine if you were holding money there and then suddenly there was a hack of the digital euro and suddenly it was like, oh, sorry, actually, you didn't insure your euros. They're gone now. So this there's a bit of a logical mismatch here with how currently things are working in DeFi and how protocols are kind of trying to like sort of say, hey, maybe it's a bit too early for us to take accountability for everything, so you can like insure your risk with us. I think a mature space would say, hey, we want to be responsible. We want to build this like better for everyone. And we're going to start like taking actions, taking measures and covering our risk for users. So we can take on more users. We can invite more people into the ecosystem and essentially help build it out. Like I was saying, we don't see anyone doing this in the space right now. And just as a fundamental principle, it seems to be where we want it to go. Take responsibility for your own risk.
Great way to put it, take responsibility. I like it. But what about the core of steady state architecture, which is coverage pools? Maybe Akash, you can share some more insight on that as well.
So, with steady state and the DeFi protocols and CeFi centralized protocols, platforms can come and create customized insurance policies that are essentially crowdfunded from the individual users. This solves like the liquidity problem in DeFi insurance, and it allows protocols and platform to sort of tailor make their own policies and customize to exact needs and source liquidity from open market investors. Coverage pools are this type of liquidity pool that locks capital assets at stake by users and insurance collateral for like a certain amount of time. And the steady states are, our three distinguishable features about our coverage pools is that they're going to be customizable, they're going to be fully collateralized, and they're going to generate multi-yield rewards. Now, I know John's a bit of a financial engineering nerd, and he would love to talk more about coverage pools and index pools and how our model exactly differs from the current offerings on the in the market today.
Well, one thing I would say about coverage pools is, and steady state, kind of like what we're building out to be, is the coverage pools there are kind of two frameworks we're dealing with, and we're working on a multi-pronged market. So we're trying to turn insurance into a form of derivatives markets or some kind of derivatives market. And so the coverage pool is like the framework layer by which we actually build the insurance products. And so what we have, these coverage pools are basically what we're doing with our policies is, rather than a lot of times in insurance, is there very specific criteria of what to go by covering and build out. And what we're doing is we're actually trying to generalize and standardize events, if events, and payout. And we're using the Keepers DAO, the Keepers network system from Chainlink to actually automate many of our systems and actually automate and make a technologically driven insurance claims market. And so how it works is a protocol needs, what I've noticed is protocols, even though every protocol is unique and different, there's like a need for customizability. There's a general need for very specific kinds of risks. And so if you want to get those generally coverage needs, you can post to get those coverages. And basically we have an automated system that categorizes these kinds of risks, how to identify them, and then and then file them for a payout claim. And so they know which ones you're covered for on that criteria. If I put and then how this coverage pool works is, say a protocol wants to post, gets $20 million of coverage. This is so rather than, we actually will probably insure a portion of it with our own DAO treasury, but basically you post a policy and people can stake capital and receive the premium for doing that. Now, there's nothing really like special about that necessarily. What really gets attractive is when we build the index pool out, but we can go over that in a second. But that's kind of like, this is the framework by which policies are paid on these coverage pools, where you stake, say, if you have Aave is willing to pay a 15% rate of return Aave tokens, and they accept USDC. So you would stake USDC and receive a 15% rate of return in Aave tokens, and basically from there, if the event happens, then pay out to Aave. If not, keep receiving premium. Now, the problem with these coverage pools is this is interesting. This is good for the protocol, but not good for the stake provider, because your upside is 10% and your downside is 100, let's say, or 15% Aave, and the index pools come in to actually solve this problem.
So I want to jump in because John has like one of the very unique talents of making insurance sexier than I've heard it before, but it's still really a mouthful. I mean, it's the first time I've actually listened to insurance for 2 months and go, okay, I'm still interested in this, but the way I've tried to put this in like a much more like easy to get stick, if I want to put it that way, is like, if you can imagine that you put my pulse on Chainlink, and there was a Chainlink oracle that was basically monitoring my signs of life. There's a two-sided market here. I mean, I smoke 20 cigarettes a day. I don't live the healthiest lifestyle. Essentially, maybe I want to take out a policy, or maybe my girlfriend wants to take out a policy in case someday I just like gone. So how it would work is very simple. I mean, Chainlink can basically see this is there, he's alive. It just likewise, people can judge me. They can say, okay, you know what? Brian seems like a pretty healthy guy. I think I want to take that premium that his girlfriend is paying every month just to make sure he stays alive, and I'll cover the risk if he dies. I know it's a very roundabout way of putting it, but like in terms of automating the insurance, it's very easy to see, okay, is there signs of life? Yes, Brian is alive. If he's not alive, pay out the money. The person who's staking the risk on the other side will eventually have to cover my funeral costs or whatever. But if you can imagine like the marketplace for insurance, the marketplace for risk, these are all like two-sided marketplaces where you can say there's a company or what very often like a country when it comes to issuing bonds. They want to cover some kind of downside risk, and there's people on the other side who want to earn yield, and they're saying, okay, I can more or less see that this there's a good like measure, or I have a good idea of what that risk really is. And something which will go on further is that steady state. Like right now, most of the insurance people in the space, you could call the insurance more of a market rather than like something which has more intelligence attached to it. And this is where we come in with like a risk database where we can essentially start to assess realistically what risk a protocol has. Look at metrics to like how many audits they've done, have they got bug bounties. There are certainly protocols which are inherently less risky than others. So we will be one of the first people in the space that will start to quantify risk, maybe as an independent third party, and then provide the marketplace for that risk. And I've done a great job of turning a very simple life or death story into an insurance story again. But I'll let Akash and John talk about the technical sides more before I get into that.
Yeah, one thing I do want to mention is that we're going to make it very attractive for coverage providers to provide the collateral and provide liquidity on the platform itself. So if you're a user and you can you want to insure a certain protocol, for example, like you want to insure Yield app, which is might be your favorite protocol. Not only do you get the premium payouts, but you also get risk token rewards. That's our native token. You'll get the certain asset management rewards that that we use your funds to sort of get returns, which while it's staked on the platform. And there's also the possibility of getting shield mining rewards from Yield or Uniswap or whichever protocol that you are essentially insuring. So there's essentially 4 different avenues that a person who stakes their collateral on the platform can get these rewards, and we want to make it. We're going to try and make it as incentivize it as much as possible on our end.
Jonathan, do you want to add anything? Nope. Or do you guys have anything to say about index pools as well? Or
I love index pools. Guys, I'm a finance nerd.
You can do the complex one. How about that?
So I'm a finance nerd, you guys. I taught myself, calculus. I taught myself coding, all these different things, just so I could get better at my knowledge of derivative finance. And I'm academically published wrote paper I wrote on derivative finance on Bitcoin. I'm like, I love this kind of stuff. Here's the problem with these coverage pools, in my opinion. They're really great. We're trying to incentivize people to buy into these pools, but for me personally, I think we'll have one of the highest reward systems comparatively to risk return in our system because you're acknowledging and buying risk. But the problem in these pools, and let's just take a base layer payout. Your payout is a 15% rate, an Aave protocol coverage pool. Your payout is a 15% rate of return in Aave, but your downside is 100% if the event happens. Now, in my opinion, you're always thinking about arbitrage, profit, and trying to find better bets to make in likeliness of premium and probability. And so with the index pool, what we're trying to do is actually, we're actually trying to build policy packages for you to stake your money into that weigh your downside risk exposure per coverage pool. And this is where it gets attractive and becomes a really tradable market. And we're going to be using Uniswap and other protocols, other groups that trade these markets through Aave and other groups. And but basically what these are these they're pools attached to multiple coverage pools, and you receive a weighted return in each pool comparative to the risk you're taking on. And as this scales and extrapolates and grows, it becomes a safer and safer token, kind of syndicated token in these pools to buy comparatively by staking money into each of these different coverage pools. So if I put $100 in an index pool, it's as a 5% exposure to 20 different coverage pools, let's say up to equal 100%. My downside in any of these coverage pools, if I stake money here, is 100%. My downside here is 5%. And let's say my upside is a 20%, 15, 20% rate of return premium in 20 different kinds of reward style token programs. If you extrapolate that to a top 100 DeFi index and you get a weighted exposure payout here, you get a payout weighted exposure at 1% exposure to a top 100 DeFi index. It's my favorite kind of analogy to give. It becomes ironically one of the safest investments you can make in DeFi, because even though you're buying the risk, your downside per event is 1%. And a top 100 DeFi index that come with the industry is constantly getting safer and safer, with your payout being a variable payout and 100 tokens paid, autonomously, just like, hourly, daily rewards that you can then check. Oh, wow, curve went up 50%. How many curve should I receive right now? Okay, let me just take that in and sell that. Or Aave, wow, I already have so much Aave now just from staking and growing this. And this becomes a base layer rate of return in the industry that people can build from, and then it shoots rewards up for everyone in the industry. But that's kind of like the index pool. It's a weighted pool system that helps protect you while also allow you to get multiple exposure to multiple protocols and multiple tokens. It becomes a really attractive investment style, I think, for a lot of people once they start seeing it.
I love your enthusiasm and then the way you explain it. So into it. So cool. Anyone else want to add anything? Akash?
I think that was actually perfect, John. I mean, you can do this yourself if you wanted to potentially underwrite 10 different insurance policies right now. You could go to, there's many great people in the space like Nexus Mutual and / so on. You can put money into 10 separate policies and 10 separate coverage pools, just like John said, but you would do it all yourself. Essentially what we'll do at steady state is we will more or less package up this risk and then give you exposure to every separate one without actually doing this step of making to back each pool. So in essence, it's what I would call the best way to put it would be just we're moving the industry along in a sense that we're trying to see what the deficiencies are. We can see how we can make it better, and we can see how we can make it easier for people, and not just people, but essentially traditional finance that wants a very secure, steady rate of return without much downside risk. I mean, this is one of the few avenues that you can come into in DeFi now as an institutional, traditional finance investor and go, okay, so the downside risk is basically 2% and you can prove it. So that's hopefully we're going to open up all of DeFi to wider audience.
Yeah, as a DeFi insurance sort of user myself, this index pool model really excites me because I can provide collateral to one pool and then get returns from different tokens as well as spread my risk. So I've been a big fan of Nexus Mutual for the past couple of years. Anyone who knows me will be aware that I speak about them quite often. And the innovations they first brought to the DeFi insurance market when they first came out. But now that model's getting more and more outdated DeFi every month. And Unslash Finance now also brought like some new things to the DeFi insurance industry. But I think our plan is to change it all up again and bring something which everyday users can use, but also of course the whole direct protocol insurance side as well.
Super cool. It's revolutionary. But let's talk a bit about risk analysis database, aka RAS. Anyone wants to give some more insight on that?
It's nothing to do with Teenage Mutant Ninja Turtles. John?
Sadly, it has nothing to do with mutated ooze and turtles. I wish, but we're basically I think. I think a lot of people. I've actually done a lot of networking and meeting a lot of different protocols and people, and it's kind of gotten a lot of market validation from this, and people already working on different kinds of versions of this. I've kind of noticed one of the biggest problems in DeFi and crypto is we have a really hard time understanding the risks we're taking on in DeFi and crypto, and especially in decentralized finance. If you told someone, I would say, rug pulls, I think were probably one of the first risks you probably identified in this space back after the 2017, 2018 bull run was probably one of the biggest things we identified. But there are a lot of different risks we didn't realize maybe what we knew were, or we didn't know would be as much of a risk as we thought in the space and industry. And I think one of the biggest problems is not understanding risk. And so we're trying to just create a database using qualitative and quantitative information to start understanding risk in DeFi and crypto. The goal is to make it relatively open source and then get into as many people's pockets as possible to use, and maybe have an open source and a closed source version. Probably be run and managed by some kind of a DAO system is kind of our plan. And basically, it's just a database by which we're going to use to understand risk in our own products and how to really get people to criticize and improve that database with us and get other protocols to use the same database as well. And so it's a community made up of other communities. But this is just basically a database we're building. We believe if you look at the historical events that have happened, and this follows through with the industry, we have precedent to prove this. If you look at events that have happened in DeFi and crypto, whether a top 100 DeFi index protocol, if there's a flash loan attack, if there is let's say a rug pull, I wouldn't really say rug pull, but maybe some kind of a black hat exploit or a bug, one thing you're going to notice or see is there is things that happen when an event occurs and things that happen after, and maybe things that happened before. And you see that because we have insurance protection as preventative and then catastrophic after the effect. There are people that are trying to be preventative in events. And the way you can be preventative is if, there are identifiable variables before an event occurs. And so one thing we're kind of building in this space is, we're taking all these different risks. We've taken all these different events, and now we're starting to find variables that happen when these events occur and put them into algorithmic logs and using machine learning. And we're expanding it to every categorized event we've categorized, trying to identify what is happening so we can categorize, identify if this likeness of event XYZ increase exponentially. And that's kind of what we're trying to build. And that's kind of what the database is. And what people are going to be able to see is this RAD database is an open source database by which they can see how we're creating these models, extrapolating, criticize, improve. And if you have a risk rating, a premium suggestion, or any of the different things, they can look at, evaluate, and criticize and improve it with us. And the goal is to actually build a database rather than making it a for-profit. It's an open source database by which we use with the community to make DeFi safe for everyone.
Yeah, this part's pretty cool because, I do degen farming all the time. I use new protocols soon after the release. So I'm really looking forward to, using this database because I think what people use right now, that there's a website called RugDoc, and that's the first place people go to check out new protocols. And it's not really good information, but that's the best we have right now. And that gives you a risk rating of newish protocols and if you should use it or not. Before that, there was a Twitter page. I think it's called War on Rugs. I forgot what it was, but that ended up rugging its own coin. I don't know if anyone remembers that last year, but it's pretty hilarious and ironic how that happened. But yeah, it's just our goal is just to standardize information in the DeFi landscape. In the traditional securities market, there's already sort of standardized information out there for every user, and to make informed decisions before they participate in any sort of protocol, or any sort of before they invest in any company. That's our goal here. Essentially, it's just standardized risk events and generalized events that so people have the knowledge and the information out that they can use before making any sort of decision.
Likewise, I don't want to derail the conversation, Akash, but you mentioned something like RugDoc, etc. I think like one of the problems we have is that there's no company in the space that's essentially saying, you know what, let's make like an archive of every DeFi attack for the common good, so that we can essentially share this out there to essentially because like you said, there's just random people will put remarks, this was good, this was bad, but no one essentially has a sense of authority over this. And like when I first met John, he was like asking me like, what do you see steady state as? And I was like, well, the way you put it to me is like we can become like a Standard and Poor's of crypto, that like, okay, we might not be the arbiters of truth, but we at least have the ability to look at a protocol to say, okay, there's some risk signals there. We have a risk database. We have all these inputs coming into it. It might be from people like Akash who are trusted in certain communities, but we'll have inputs. And I mean, thinking about like big picture, there's no reason why there might not be an alliance of insurers in the space. I mean, I believe this happens in traditional insurance, where you have closed databases where you share risk on certain people. I don't know, potentially share medical information is something people get a bit touchy about now, and going down like what's happening in China. It's, essentially privacy, but I won't touch on that. But there's a lot of space to sort of build this product for the common good. And like, I don't see anybody right now in the DeFi insurance space saying, okay, let's try to build together a database of risk. Just like this. And I think even anyone who's in the industry and is interested in this, like we're always looking to partner and look for more like data sources, and anyone that has an interest in this, I mean, please do reach out, join the community. That's what we're trying to build, is like a bunch of people that are very much like dedicated to making this space better. And that's essentially what we're trying to do right now when it comes to building out the product white paper and essentially release. Yes.
Yeah, I think this sort of database is definitely needed from investors' point of view as well. So I'm so happy to hear that you guys are working on something like this. So that's awesome.
I just see we have a lot of like questions here in chat. I don't know if we want to like touch on them, but I know
we will answer them after we have discussed our things.
Sure.
I just wanted to talk about automated claims as well, because I think this feels revolutionary. Because right now, at the moment, for example, when a project gets exploited, you have to fill out a form or write to the admins yourself. But Steady State introduces automated claims. Can you guys touch down on that more specifically?
Yeah, so automated claims, that is, we have some precedent of this in actual markets and financial markets. We don't realize it often. There is something in the industry called parametric insurance. Parametric insurance is an agreement between, say, a business and an insurer that if an event occurs, we get an agreed upon payout pre to the event, and we agree to pay XYZ premium if the event occurs. Often, these kind of events are called catastrophe events, something that, we really don't share a lot of responsibility for, which is kind of like the usual term how parametric is used, where these events happen and it's out of our control, and, we deserve payout if the event happens. And these are like for like hurricanes, tsunamis, earthquakes that use parametric insurance. And often the payout usually, and we're applying a little bit of differences in our style, but the agreed upon payout is you have a building. The average cost of a building of your size in this space is XYZ value. So because they have value, if the building is destroyed by an earthquake that has a XYZ number on the Richter scale, XYZ damage done, then payout. And it's on public, transparent data. The problem with, there are two kinds of insurance: indemnification. If an event happens, you go in and evaluate the event, and then you figure out who's responsible for what and who's owed what. That often happens between two insurers, in a car accident. Parametric is like, this is out of our control, there's a payout. So kind of what we're applying on the Keeper system is we're using the transparent on-chain data using and tracking it and injecting the smart contract using the Keepers network through Chainlink. And our kind of goal here is to from the Keepers network and Chainlink is to identify these events, categorize, and figure out which kind of event happened. And rather than creating a payout, an agreed upon payout, we're going to pay for what's collateralized. There was a question asked I'm going to get to real quick. I'm actually going to answer now. They asked, what is the maximum amount a company or product can insure for? How our coverage pools work is you can post a policy size for 20 million, but you're only paid for whatever is collateralized and backed up. So if you have $15 million on a $20 million policy, you can only get up to a $15 million policy. So the Keepers network uses a transparent on-chain data to identify, categorize, and create payout for event. And that 10 to 15, then say if you're collateralized for a $15 million period, either the Keepers network will look at transaction hash feed and create the payout themselves, or the protocol will submit like a transaction hash feed on the smart contract and create a payout for that amount on the parametric insured. That's how it's automated, where you identify, categorize with the on-chain public data and then pay out whatever you're collateralized or covered for. And so this actually creates a lot of gamification. We can probably, if we want to talk about that. And so that's how you automate that process. Now, we do have a human element here. If you think about Nexus Mutual and all these different protocols, they're built on mutuals, where if an event happens, you go to a mutual and they vote whether or not an event happens. Our process and approach is the Keepers network works with a smart contract, automate and create payout, and negotiate with a smart contract what happens and agree upon the payout. But after the claim is processed and approved, we have a 10 to 15 day lockup period, let's say. We haven't agreed upon like a specific day. If you think about these 20 million policy payouts to businesses, this takes 6 months to years, a very long time. The payouts need to be quick in crypto. So we're trying to maybe take a 10 to 15 day payout, maybe maximum. And basically it's a period of time for people to evaluate the tech and what happened. And people have to come up with proof of fraud that the tech is wrong. This creates a human element rather than, people evaluate the event. Tech evaluates the event and people evaluate the tech. And that's the process we're kind of creating. And so that 10 to 15 day lockup period it's automated up to this freeze up period. And people have to come up with proof of fraud that the tech was wrong or that there was bad actor activity by the protocol during that time. And I think we can identify a lot of that in our postmortems, when postmortems come out. And so that'll give us a time period for us to evaluate to make sure it's good, because we're dealing with $20 million policies and people's money. And on this system, so we want to make sure the payouts are solid and good when the events do happen. And ideally, what would happen? Maybe the treasury creates the payout, and the treasury pays out the people, and then the treasury gets reimbursed by the policy size. And that's kind of how we're trying to build.
Anyone wants to add anything?
Just one point, like plain and simple. Having automated claims, it just removes the bias in the settling claims and the whole process. It'll give more confidence to the protocols that that their claims can be paid out in the event of an attack, and I think that's really important for decentralized finance. There's been claims by Nexus Mutual which have been denied in the past from people voting, and these claims were completely legitimate, but for some reason, because there was a bit of a conflict of interest between the people mutuals voting and like the people who provide the funds on the platform itself. They were denied, and we want to try and avoid this problem. So yeah, it's going to create more confidence in our protocol itself, and of course to the protocols who are seeking a policy on steady state.
Yeah, just really adding on as well. Like one other thing that we're building in here as well is like if you've seen there was ThorChain was hacked recently. So I think what I followed up is like they didn't have insurance for the event, but what they are doing is that they've used their treasury to essentially reimburse victims who had lost funds. I mean, what with steady state, with the model we've been proposing is that instead of actually holding this reserve and paying it out in the event of this happening, I mean, ThorChain would be essentially able to put or stake their reserve on steady state, earn a premium on their own downside risk, and then in the event of the event happening, they would be much less exposed to their own risk. It would be collateralized inside of the index pool. So in terms of like protocols and how to make use of their treasury, we're more or less building out a use case where, okay, you don't need to keep it there to reimburse in case XYZ event happens. You can make use of it. You can put it there on steady state and essentially earn like yield. And like, even if I look back at CeFi platforms, like I remember there's been incidences on like OKX, Binance as well. And in the past, I think a lot of these have like utilized their own like insurance fund So every time you trade, they're taking like 5% or whatever percent of fees, holding it somewhere that essentially is not doing anything. It's not earning yield. It's just like static reserve fund. Or maybe they have put it somewhere. We don't exactly know. It's pretty opaque. And that's essentially the point. Like, to us, it seems like we're inventing a better model for utilizing what could be currency reserves, and essentially not having them there for the event of like some black swan where they can use them then to essentially reimburse. That's essentially one of the, I would say, the core products we're trying to build out.
Thank you. I love that explanation. Good one. But maybe you want to share now more about the steady state company overall, the team, the philosophy behind all of it. So everyone will know.
Well, where to start? I don't know. I can speak for myself for most of this call. What would you say it started from memes, John? I mean, like we're both very. Me personally, I'm like studier of memetics, meme culture. I don't know. Where do we make an interesting story here? I mean,
oh God, I mean, for me, I got involved with DeFi in the fall of 2019. When I found out DeFi had interest that paid by the hour, by the second, that blew my mind. That you had immediate access to as a financer, and I'm like, what? Like, and so I really fell in love with, a lot of different protocols and what they were doing. And then Yearn Finance really blew my mind, where it was an automated smart contract that would find highest APY lending yield for the initial build out on like Aave and Compound, all these other different protocols, and finds the highest APY and DAI, and it would just naturally move the money. It just showed how disruptive this could be for banking systems. For me, I was under the assumption that one of the most convincing arguments, or one of the most attractive arguments to get institutional finance in the DeFi and crypto, would be some kind of a bond market system that pays high yields of 10 to 15% comparative to equity markets and regular markets. But here, 10 to 15% could be like maybe something about bond payout structure, I think, in DeFi and crypto. And I thought if you could build this out, there's a lot of like, that was kind of like what I really thought would be one of the most convincing arguments. So I started putting a bunch of concepts and ideas into those kind of the market systems. That's not like different from steady state, but that kind of just shows like where I kind of like started like thinking about models that can be built, is some kind of like risk reduction system that creates higher yield payouts. And kind of where steady state came out was a fundamental belief that, I don't believe individual sovereignty is sacrificed by having protocols endowed. I think we live under a system in DeFi and crypto where we're so individual sovereignty that we should be responsible for protecting ourselves. But we're also a system of communities. And these communities and these structures can also can come together and protect each other. And I believe the concept of individual sovereignty is not sacrificed by building a system where protocols protect and DAOs protect their communities. And so I thought if we could create a mutually incentivized model, to build for both parties, for communities, while also protecting new people and new users, I believe, we could have created a better system for everyone. The mission statement of Steady State is really moving DeFi forward, bringing DeFi into new markets and new people and making it mainstream. Just like Yield App, just like BlockFi, just like Celsius, pulled together and all these different protocols, we stand with that same mission, where we're here to make DeFi mainstream and better for everyone and make it available for all people. And protection and safety is the key aspect to bring that. That I would say is our mission statement. Our team, we have Brian McCabe, who has a pretty impressive background in marketing and product marketing. He's our CMO. Akash, who has a pretty big, substantial background in DeFi and crypto, as well as a legal background. He runs our operations and strategy. Myself, I'm easily the youngest person on the team. So, it's kind of, everyone else is like 30, then we also have we have a pretty substantial background of marketing and product. We've locked in a pretty impressive CTO we'll be announcing probably end of the month. We're doing a lot when it comes to the team. We'll probably have 20 people staff probably after the final build out while we're building. And it's all focused mostly around product and marketing and legal, to making sure that we're compliant and doing things by the books and being transparent with how we're building things, making sure our marketing is good and strong. We're building that as well. And product, making sure our product is superior to the industry. So if you want to break out a team, there are 3 prongs, and there is, Cash, myself, and another person doing the operations, the BD, and everything else. But those are kind of like the 3 things we build our team around. 2 legal, 5, 6 marketing, and then 4 product, 4 or 5 product, and then me and Cash just chilling. But that's kind of like what we kind of built this to be. And we're pretty, that's kind of the breakdown of our team. Our mission, we're just trying to make DeFi the norm. I am under the conviction to believe that DeFi and crypto can change rate of return for the average family in the US on their pension funds from 8 to 10% to 20 to 30. And that doesn't sound crazy. Maybe it sounds crazy to other people, but I believe that will be one of the most transformational impacts of wealth equity and equality across a global level, and also helping families substantially. If we can solve poverty, if we can solve money problems for a lot of people, we can really start solving serious problems in the world by allowing people to think freely about other problems that need to get solved, by focusing on getting past the need for survival on a day-to-day basis. And if we can, DeFi can do that. And if we can create a safer environment for DeFi to protect everyone and make it safer, that's what we're here to do with Steady State.
Yeah, I'll actually coattail on that, because John is saying like he's extremely the youngest member in the team. I'm probably one of the oldest, but I came actually talking to him like from, maybe 10 years background in Bitcoin and crypto. And like, when I heard of DeFi last summer, I was like extremely skeptical that this is going to last. I was like, okay, so we have like Yam Farm. Like it just seemed like a whole meme community of people that don't know what they're doing and have a summer off. And like, but the thing is like, what I really like in this team is like, when I first met John, I was like, okay, yeah, I get it. Insurance, the whole place is a bit crazy. So like, the more and more I've questioned him, the more and more I've challenged him, the more and more I've said like, okay, but isn't the index pools just going to create like a systematic event where like all of DeFi is going to collapse because you have over collateral? We have some really fun conversations in the background, and like I can say that he has more or less changed my view on DeFi. There is a big industry here. I even think that just the idea of like autonomous legal structures is something which is becoming, more and more even talked about in centralized world. Like I see World Economic Forum are always talking about how we can more or less make things autonomously happen with like rules-based systems. And like, to me, a lot of this is very synonymous to what we're doing in DeFi. And I had concerns, and then I realized, okay, one, I'm working in insurance. I'm trying to make this safer. So maybe I'm a skeptic, but I'm a skeptic that is really turning around to sort of saying, okay, we're fixing these problems. This is really cool. And I will just say, this is why I'm here.
Akash, do you want to add anything?
Oh yeah, sure. Look, these guys covered it pretty well. But I mean, before I joined the team, the main question I should say was, I asked myself is, should this product be built? And that was an emphatic yes. There's nothing in this, in the DeFi crypto insurance industry that exists. We're targeting protocols, and everything that was on offer obviously only catered to retail insurance. So yeah, that was an easy yes. And the other question was, can we build a sustainable business model around this product and services that we offer? And that we've had quite a few discussions over the past few months, and I think what we've designed is going to be very solid. We're going to be a revenue-making company, and it's going to be very sustainable for the long term as well. So we've got big plans to be revenue positive from day one. Keep expanding our product range. Expand it even outside the DeFi insurance industries. Decentralized insurance and other sort of real life insurance and stuff. So it's going to be like a long-term project for us. We're here for years and years, hopefully. And we're really trying to make something which is useful, not just another, farming protocol or another like AMM DEX that comes up every week. So it's exciting to be here. And but yeah, it's definitely like something which will take a lot of time, and it's not going to be all smooth sailing. It's going to be a lot of up and downs. It's going to be some tough weeks, but we're here for the long haul.
Thank you very much. Well, I personally think that you guys have a really great and strong team that you put together, and a great project. So I'm very excited to see what's all going to happen. But yeah, let's see now. Our first giveaway winners, who were College, Tao, and Zoom Crypto community, who asked questions on our Twitter page. So let's see the 3 questions that were asked. So colleagues asked that revenue is an important aspect for all projects to survive and maintain their project/company. What are your plans and ways to generate profits for the token of the token? In regards to this, please explain your income model.
So, I mean, I'm not going to talk about the token. We can maybe jump on other conversation to talk about the token itself. How do we generate revenue as a company? I think, we'll have a DAO reserve that's active. We'll have our own treasury reserve that's actively investing and growing. We're going to basically, when you want to build a policy, we'll take a very, very small percent of policy growth. And so you're getting paid your rewards autonomous in the premium. And so when you go to redeem your rewards, we'll probably have to take a really low percent that'll be fixed, on a total value. And when it gets redeemed, we'll receive a premium on that as well. And it's going to be so when the protocol policies are built and when these are actually bought and traded, then we'll receive a premium there. Because ideally, we're building syndicated tokens. These are these index pools and these coverage pools. If you put 100 USDC, you're going to get a synthetic token, 100 synthetic USDC, let's say, that's going to be traded in secondary markets, ideally, for whoever wants the rewards. And so when those go back into our system and be redeemed, we'll receive a premium. We'll probably be receiving interest on that or some kind of a really, really small fee on that. And so the goal is to incentivize more trading volume on the line, and that'll come from there. And then we'll also have a DAO treasury, so that's going to grow. And we also have plans to make our own kind of exchange internally at some point, Steady Swap. And we're going to basically collect some kind of revenue in that as well. The goal, so it's just we're going to generate revenue from use is going to be most of the revenue generated. There'll probably be some kind of fee collection on the tokens where if you hold a token, you'll get a portion of the fees as well as, and we'll let a DAO figure that out as well. We'll figure out this community as a whole, who will be entitled to what. And we also have a treasury system, it's going to grow. We'll also have our own reserves. So we'll generate revenue from being active in our own system, generating revenue from outside of our, from people using our system, and then people will be able to partake in some of the revenue as well by holding our tokens and being active within the community.
I have a question, John. Sorry, next time I need to totally bring up whiskey just because it's just got me thinking. The way that we're going to do the secondary market, I mean, if you can imagine us tokenizing Aave insurance, like a P Aave token or SS Aave, so you can essentially sell your stake that's covering them. I mean, if you can imagine, over time, the price of this Aave insurance token might rise or fall. I mean, don't you see ourselves creating essentially we will be tracking okay, the premiums for Aave just went through the roof. Is there something going on
this
there?
Is fun. This is just really fun. The Aave payout premium is agreed upon comparatively to the US dollar value. So if you expect Aave to decrease in the long term for decreases, your premium payout decreases. And if you expect an increase over long term, you'll buy it. And if you have the ideal world will be creating different kinds of brokerage markets that have different levels of controls. AMMs cannot take in consideration yet. They can using Uniswap V3, but not amazingly. These price movements. Aave tokens could be, even though you're receiving a 10% return on Aave tokens, it could be worth theoretically 40% if you see Aave move. Long term is being received and realized and actualized. And that's kind of the interesting part where there's going to be a discount and premium flow on the principal stake, and then you'll be able to trade that value internally. And so ideally, you got to mirror some kind of a market that has those kinds of rates. You have discounts and premiums and principal values, and actually apply that where you're going to trade on that. And there's precedent that in the industry for us to build that off of, and that'll create new models and actually a brand new kind of asset system in DeFi and crypto. When you actually think about it, we're turning business insurance into an attractive, crazy, liquid, tradable market. That's kind of a new we're trading principled risk, and it's really exciting. And it's what you're saying is exactly right, Brian. You'll be able to eventually, as the industry evolves and grows, you'll be trading on the expected future premium and discount flow of these token movements on top, which will be really cool.
I love how when you get excited, I stop understanding what you're talking about after 30 seconds, but I'll recap it.
I agree. I love when you get enthusiastic. It's cool. But we also had a question from Thar. So in your opinion, Can DeFi come into the mainstream of the financial industry? And how does this accelerate the transformation of the traditional financial industries?
Oh yeah, these models we're building off of are actually structured products seen in institutional finance. So it's funny. We talked to a lot of guys in institutional finance. They're like, "Oh yeah, I know exactly what you're building. It makes total sense." So like they're actually really interested in our products. Could you imagine if institutional finance is insuring your risk? That's freaking great, and they're willing to do that. And they're finding there's a lot of attractiveness there. When it comes to bringing things mainstream, think about an amazing project like Yield App. I think, based on customer research we've done, and Yield has done a great job insuring themselves already. But if you can tell people, I can get 20% on my USDC, and am I insured? If you say yes, what is stopping you from putting away? If you can get 30% premium on Curve, using some of its terms, what is stopping you from using getting serious about the Curve is insured? Yield App, what is stopping you from putting a stupid amount of money in Yield App if Yield App's insured? If you think about all these different kind of protocols, if you know for sure everything is fully insured or has some kind of level of collateral backing it, like an FDIC baseline, you're going to put a lot of money in it. And if you think about DeFi, we have about 100 billion plus in AUM or TVL, I think is a better term, TVL, without any kind of real business insurance. What's it gonna do when you hear Uniswap has precedent? All these different protocols have some kind of a protocol insurance. That's not based on some ridiculous criteria on a syndicated pool. Some kind of ridiculous criteria on a syndicated pool, but actually has real automated precedent that's generalized and creates a payout. Holy crap! I am going to throw so much money in this system. And you're going to watch the TVL moon for everyone, and it's going to be amazing. And that's what we're planning to do. We're going to build a new asset class, and we're an asset class that makes sense. And then on top of that, we're basically giving people no reason when you say the protocols are insured to not get really, really active in DeFi and build a career here, whether in a DAO or any other system.
Yeah, I think this is where the risk analysis database can also sort of help smooth the transition for institutional investors to come in, because institutions, the big ones, the traditional institutions, they're not going to do anything unless they've got a lot of data and a lot of information about what's happening in DeFi. So once our database actually accumulates all this information, it's going to be open source, it's going to be machine learning, and it's going to keep going on and on, by itself after a while. Now, if an institution has all that data, they'll know the risks attached to each protocol, and they can put more money in, not just our platform, of course, to insure risk, but maybe they'll be like, oh, look, this is Aave, this is Yield. I know the risk behind these protocols now. I know I have more information about it, and they can be like, yep, I'll put 100 million in this company to get some more assets under management and get a return off that. So I think the risk, low key, I think the risk analysis database might play a big factor in that. It's going to take a bit of time to build that out and get the right sort of data with all the hundreds of parameters in there. But it's going to be exciting to see what the database actually does.
I love that point, to create this risk analysis database for the institutional investors, because they all look for this data that they want to rely on. So that's a good one. Do you want to add, Brian, something? You're on mute. I think it was a no. Or yes.
It's okay.
Okay.
Sylvia, you're muted.
Sorry. So our last winner was Soon Crypto Community, who asked, insurance is a sensitive topic. It requires personal data to be adequately tracked, what needs to be insured. As we know, blockchain is about anonymity and hosts decentralization on a high standard. How your data will be stored and protected from hackers and other smart contract exploits.
Well, see, I always hear that, like on an insurance policy, what data are we storing? We're a protocol working with other DAOs. So if a DAO lets your DAO post a policy, it's agreed upon that you can get a policy agreement. We're not storing names, passports, and all other stuff. I think luckily we'll have brokers that handle that if people want to go that route. We're working on a couple different strategies, but in our own system, when it takes using it, protocol like pool together, we'll make an agreement, say, with pool together to post a policy. We'll make an agreement with Yield App community to post a policy, and they get a policy posted and covered. People who want to use the system and stake, using our system directly or trade on Uniswap, even if we acquired it, let's say, if we had to do the legal verification, some kind of tracking on that information. If we stored it, we have to serve it we have to figure out how to do that, which I don't think we need to at all in using our system. But if we did, you could just focus on buying and selling on the Uniswap anonymity on the secondary market, let's say, or on Sushi if it's built on Sushi as well, because there are going to be ways you guys can work with this, where we're likely going to buy and wrap these into brokers where that would do perform KYC if institutions are really interested in this product using our system. If you don't want to, say we had to require even using our system, some kind of layer, this is going to be moved out and traded on secondary markets. So you can easily buy and trade that then on Uniswap or Sushi and be able to get access to that as well. But I don't see us storing any information like that. I don't think it's necessary in DeFi and crypto. Protocols will be allowed to post their own policies because the protocol is allowed to, and it's voted the protocol to. I think thinking probably some kind of similar network to like Banker or something, Bancor. I would say on top of that, using our system to stake, we currently, I don't plan to put a requirement there to stake. I think we'll have brokers end up buying that do that requirement, and but if we're building it right, even if put a requirement, because we had to do legal verifications, we could easily move that into, these assets are going to be moved off and traded in secondary markets, and you can easily get access to buying and selling the coverage risk in those secondary markets.
Nice. Does anyone want to add? Akash or Brian? Nope. All right.
You're muted again, Sylvia.
I'm sorry. I put myself on mute because I think that some of you is going to answer to me right away. And then I forget. Sorry. But what I was saying was that some of our viewers also had questions. Jonathan already answered one question, but Tangled Lotus asked that, are you guys building a system like Federal Deposit Insurance Corporation?
You're talking about FDIC insurance? So our insurance is very customizable. If a protocol posts a policy, they can distribute and offer some kind of a base layer coverage like the FDIC. So FDIC is an American banking insurance policy that covers, I believe, up to $250,000 per person within a certain bank, as long as the premium is paid out by the bank or community bank. So what we could do is say if you have a group like Yearn, a whale made from minnows is a good context for Yearn. That they get a policy and they get up to like $50 million in coverage. They can offer some kind of a base layer coverage for everyone, like an FDIC. It's up for the protocol and how they want to distribute and use their own insurance policy, because we're insuring them, and then they use it to take care of their community. And obviously, a lot of these communities and protocols are run by DAOs, so it's a community taking care of themselves. And basically, if they want to make an FDIC base layer, they can. They'll know what's covered, they know what's collateralized, and they'll have a dollar for dollar backing on whatever they need covered. So they can choose to do with it as they please and expand it as they please. I see a lot of protocols literally posting their own downside risk and then buying it and paying themselves and offering opportunities on their own protocols and actually arbitraging profit using our system while getting effective coverage. It's almost like a better system where you can extrapolate. You can actually like 5 times your coverage than you ever could with a treasury if you build this right. And 5x, your coverage than you ever could with your own treasury if it's built right, your policy right. And that's kind of like where I see happening. It's going to be protocols going to choose how they want to cover it. I have a feeling a lot of them will be like, we have this policy, we have this XYZ covered. You sacrifice XYZ on your premium, and we'll offer you insurance internally, or they'll just say it's covered FDIC. And I think that'll be marketing up to each project to figure out how they want to do it.
Yeah, just to add on like one tiny point as well, like it can work like FDIC, where essentially like you have this a whale made of minnows like in Aave, where okay, we'll cover everybody up to maybe 10,000 USDT, and other than that, then it's potentially like you're on the line. The other way is like we have partnerships with many like yield aggregators, like Yield App and similar. Others will be coming soon, but there's also the opportunity where, like, let's say I put my USDT on Yield App and I'm earning 20% premium. My downside risk is, okay, potentially if there was a black swan event there, my funds that I've given them are invested somewhere else and I could be exposed. There's also the opportunity, let's say, for companies like Yield App to say, okay, we can charge you, Brian, 5% off your premium to make sure you're 100% covered. We'll give you a 15% payout, and essentially this means that you have no risk reward, essentially, on that side. So it can be that like protocols can cover their insurance, or it can be that protocols can use our insurance and then potentially like upsell it on their own platforms themselves, potentially making a profit, like John said.
That's great, thank you. And we also got a new question here from EJ Vanderberg, who asks that how come it feels like so many projects are lacking insurance at the moment? Is it due to high risk, like drugs, exploits, etc.?
There's no business insurance, EJ.
Yeah.
That's what it is. That's what it is, EJ. It's like I've talked to a lot of protocols. They're like, oh yeah, we're all down for this. We're so down for this. Where have you been? I was talking to some guys in the Thorchain community who are pretty high up there the other day. They were like, "Where have you been?" It's just like that seems to be the need, man. It's that's a good question. I don't understand. I think it falls under our philosophy in crypto and DeFi, and I think there's some kind of maybe a lacking point there in our philosophy where we believe, you know, we a lot of us fundamentally believe in individual sovereignty, and you take responsibility for your life and everything you do. And I think the assumption is you're responsible for your own assets, not your keys, not your not your bags, or not your keys, not your coins. And I think one problem we see from that is sometimes we think like, is insurance for protocols too centralized? Well, I would say no. It's if a DAO is insuring another DAO or creating a system for another DAO to use, that's not a big deal, And the idea, if you think about how insuring protocols actually be expansive, in actual, ensuring protocols can actually be expansive and expanding individual sovereignty just by taking care of communities. And I think it's just going to be a narrative shift where it's not one central group ensuring another central group. It's one community protecting another community. And I think that, and the goal of the expansion of individual sovereignty, allowing another more protection, allowing more people to have freedom in their own bags, in their own protection, And I think that's kind of be the narrative shift. That's my opinion. I have no idea if that's true or not, but you're right. It's kind of ridiculous. Why isn't there business insurance? And, the best you can do is get a retail policy on Nexus, which I love Nexus. They do great, but it's like you're insuring yourself for your exposure to the downside of, say, Curve failing due to an exploit. And you're the one injecting money in Curve to support Curve, and you're the one who gets hurt from supporting Curve. It's like what's the disconnect, guys? And it's the Curve DAO, is which they're great and they're doing great work. I love Curve. Is like they I think the Instagram game is like, where are you guys? Because they're all down for this. Everyone's down for this. It's more or less just building the markets now.
Yeah, like I mean, DeFi started as the Wild West, and it never really left that sort of mindset, which is a bit frustrating for most users. Now, I think what we're trying to create like a standard, like a certain standard that every decent protocol should follow by insuring themselves, for example. That's the goal here. We want to make it like we want to offer a product out there which each top 100, top 200 DeFi protocols, like, yes, we can buy this insurance, we can insure our users, we can build confidence in our own community, gain some legitimacy, and it's a win-win situation for them as well as the users, as well as anyone else who wants to come in to use their platform. So that's the goal here. We're trying to create that standard. And it's a good question, like why people don't have insurance, because we just don't know. It's a bit frustrating for users lose their money every day, every week, whatever it is. So yeah, we're going to change all of that. Hopefully, that's the game plan. That's why we're here. That's why we're building Steady State.
Yeah, I just very quickly add on, so I know we're running out of time. Is that like maybe 7, 8, 9 years ago when I was like living in Finland and I was using my free electricity to like GPU mine Bitcoin, and I was putting this like mined Bitcoin by me into slush pool or whatever it was. I mean, there is this thing that like DeFi is built by tech people, and tech people don't give you instruction manuals, or like, you know, it's your fault if you break it, and it's your fault if you didn't do it right. And like I've seen Bitcoin evolve from this like very experimental space where people were essentially told, hey, it's your own fault that you didn't know how to do it, to like, okay, now we have these advanced products. We have like, I mean, all the major crypto banks like Coinbase, they all have their funds insured. I mean, even Coinbase is FDIC insurance now. So let's just chalk it down to evolution. I mean, the first people in the space, they're a bit more short. They don't write instruction manuals. They expect people to know what they're doing. But it's going to evolve. It's definitely not going away. That's for sure. So for me personally, I'm glad I have a second run at a whole new technology without making all the weird mistakes I did in Bitcoin 10 years ago. So yeah, second time lucky. Let's build this right.
That's awesome. If anyone wants to add anything, you can. If not, then I think we can say many thanks to our speakers, Jonathan, Akash, and Brian, for giving us all this information and insights. And now it's time to announce our second giveaway winner, who will win the $100 in stablecoin. And let me see, you all have to post your Twitter handles here. And the winner is, I don't know if I pronounce it correctly, but Light and Lava. Yay! Congratulations! You have won. Share it with your friends. Sharing is caring. And that's it. Thank you all for tuning in. See you all next time. If you have any more questions, make sure you join our Telegram community. Follow us on socials. And keep an eye on, because we'll probably, most definitely, will do this type of fireside chats again. And enjoy your evening.
Thank you, everyone.
Thanks, guys. Thanks, Sylvia.
Take care, everyone.
Bye.
Bye.